Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, covering foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jason Campbell, Business Development Leader at Strategic Treasurer. All right, welcome to another episode of Coffee Break Sessions. We're going to talk about asset-backed debt. As part of our series that we've been talking about raising capital, we're going to talk about another great subject here. And again, speaking with me today is, we should probably just call him Doctor of Finance or Doctor of Investing, because, man, he is just so like an encyclopedia of knowledge here. So, and I'm always thankful to have the opportunity to talk with our senior advisor here at Strategic Treasurer, Paul Galloway. Paul, welcome back to the show.
Yeah, thanks. Thanks for having me back, Jason.
I mean, would it be bad if I called you like Doc? Could I call you like Dr. Paul? Would that be good? Or you're like, nah, I'm good. I'll just stick with Paul.
I'm good with whatever. I'm flexible.
You're good, whatever you want to call you, right?
Yeah, it's all good.
Let's kick it off here and just go right into what is asset-backed debt?
Yeah, I'll try to keep this in its simplest terms because this type of issuance is really pretty unique. But in its simplest form, what asset-backed debt is you have a company that is simply wanting to purchase a book or pool of assets. And what they do is they issue debt and simultaneously they go out and they buy the assets. That's asset debt.
I think it was like, a couple episodes ago, and I was thinking to myself, when we think of debt, we think of it as being a bad thing. But in situations where a company can really take advantage of selling off debt itself and raising capital that way is such a unique concept. And I can see it on both sides. And so these past couple episodes that we've gone through just made me really kind of open my eyes to these other concepts of raising capital versus just your traditional thinking. So pretty interesting. So as we talk about that piece of what asset-backed debt is, what are the different types of asset-backed debt issuances are there?
Yeah, that's a great question. Generally, it's kind of just overall one type of structure, but what makes it different is the types of assets that are backing the debt. That's what makes the types difference, because so you can have a set of assets that are mortgage loans or residential mortgage loans. So they call that RMBS. It's the same thing as ABS. Asset-backed security is ABS. RMBS is residential mortgage-backed security. They're different types of issuance because of what's backing the issuance. And so you'll see auto loans, aircraft leases, corporate loans, credit card debt, residential mortgages I mentioned earlier. Those are some of the typical types that you'll see for any type of asset-backed issuance.
It's funny. I go back and I think of childhood and I think of my parents, and the things that we would say as kids, my siblings and I. And the things that, as like that Progressive commercial that says, you becoming your parents, right? And I know that like at times, like with my kids, you brought up a couple interesting points. And my kids are like, well, Dad, we own our house. I'm like, no, we don't own the house. The mortgage company who, they own the house. We pay them off until, the debt's paid for, right? Which just goes back to being asset-backed debt, or a vehicle, as you said. Well, it's our car. Well, technically it's not until if you finance it and, the bank or whoever did the financing for you is the actual owner of the asset. You're paying it off to them until you pay off your debt. You will be the sole owner of your asset, right? So it's an interesting piece, and I find myself talking to my children that same exact way as I start to teach them a little bit about finance. So that's a great example that you pulled up. So I appreciate you kind of hitting on that, and that's just what first thing that came to mind as a parent. Now, why would a company issue an asset-backed instrument?
Typically what's happening is the organization is looking to buy a book or pool of assets that they believe they can fund the purchase by issuing debt and get a better return than what's going to be owed on the debt instrument that's issued that is issued. What they do is they create what's called like a SPV or special purpose vehicle that acts as the conduit for the issuance of debt. And that vehicle will be the issuer of the debt and the purchaser of the assets. And what the company's betting on is the cash flows tied to those assets are going to be greater than the cash flows that they have to pay for the debt. It's a spread game is really what it is. They think they can beat the spread. And companies do this all the time. There's all kinds of asset-backed securities that are out there. And it's all tied to what the organization that is purchasing the pool of assets and issuing the debt at the same time thinks that they can do.
It's funny you said, beat the spread. And all I kept thinking about was, like a Vegas sports book room, because it's football season. And that's what's the spread? What's the spread you hear, right? So that's why first thing that came to mind was just thinking of, some casino somewhere, somebody's screaming out, beat the spread. So, but I could totally see that the same thing, that gamble piece of it. So what risk, if any, are associated with this type of issuance?
The risks associated with it can be, let's take auto loans or credit card debt, or any of those examples I gave, mortgages and so forth, is that the cash flows, the underlying cash flows associated with the purchase of those assets don't pan out to be what the organization expects it's going to be, meaning that there's more bad debt write-offs than what was expected. So your cash flows shrink because you're writing off bad debt, or people are defaulting on their payments, for their mortgages. Corporations don't have cash flow to pay any of these instances where there's a risk that the cash flow doesn't pan out to be what you expect. So then cash flow shrinks in totality, and the margin or the spread that you think you're going to earn shrinks along with it. And so you're trying to mitigate those risks as much as you can. The key is that the organization that's going to issue the debt and buy the assets really has to do good due diligence on the underlying cash flows and make sure that they understand what's going on there.
So thank you for joining me today, Paul. Again, always love hearing your insights and perspective and just taking me to school on these all topics related to Treasury and finance. And for our listeners, please ensure to tune in every first and third Thursday of the month for a new episode of the Coffee Break Session. As usual, if you have any questions, comments, or feedback, please send us a note at podcast@strategictreasure.com. Until next time, take care.
This podcast is provided for informational purposes only, and statements made by Strategic Treasure LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.